Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the stocks that actually matter. Before we dive in, quick reminder, if you haven't subscribed yet, hit that button now, because today's video is exactly the kind of deep dive analysis you come here for. NIO just hit Record Deliveries, right before one of the biggest product launches in the company's history. And what happens next could completely change how the market values this stock. Today, we're breaking down the numbers, the strategy, the competitive landscape, and the one hidden metric buried inside the data that most investors are completely sleeping on. Stay with me, because by the end of this video, you'll know whether NIO has finally earned a spot in your portfolio, or whether it's still too early to pull the trigger. Now, for nearly a decade, the single biggest knock against NIO was that they were essentially a charity for luxury car buyers. Billions of dollars burned year after year, with no clear path to keeping a single cent of it. Wall Street called it a high-burn experiment. Critics called it a money pit. But that narrative just hit a brick wall. The data coming out of early 2026 isn't just a beat on expectations. It is a fundamental rewriting of what this company actually is. We are watching, in real time, the exact moment a high-burn startup transforms into a self-sustaining, scaling manufacturer. So, let's talk about the three cylinders NIO is firing on right now: profitability, growth, and moat deepening. For years, management told investors to wait for the scale. Well, the scale has arrived. They aren't just selling more cars. They are leveraging in-house silicon and a massive infrastructure network to lock in ecosystem value that their competitors simply cannot touch. This is no longer just about moving metal. This is about owning the entire energy and software stack. But talk is cheap, so let's get into the actual numbers. In March 2026 alone, NIO delivered 35,486 vehicles. That is a staggering 136% increase year over year. When you zoom out to the full first quarter, they hit 83,465 total deliveries, nearly doubling their performance from Q1 last year and blowing past the upper end of their own guidance. But here is the real mic drop moment: GAAP net profit. In Q4 of 2025, NIO posted a profit of $40.4 million. Now, in the world of big tech, 40 million might sound like a rounding error. But for a company that has been bleeding cash for years, this is a historic pivot. It capped off a year where they slashed net losses by over 33%, sending a clear signal to every institutional investor on Wall Street that the era of growth at any cost is officially over. So how did they pull this off while the rest of the industry is locked in a price war-induced panic? It comes down to one specific profit engine. Meet the ES8 SUV, the crown jewel of NIO's current lineup, doing the heavy lifting for the entire balance sheet. We're talking about 80,000 deliveries in just 181 days. It held the #1 spot in China's large SUV segment for 3 consecutive months. But for you as an investor, the most important number isn't the delivery count. It's the margin. The ES8 is operating with margins of approximately 20%. That is the cash cow generating the high margin flow needed to fund everything else. The aggressive refresh schedule on cheaper models and the bleeding-edge tech in upcoming flagships. But NIO knows they can't conquer the world with luxury SUVs alone, which is exactly why they've moved to a 3-brand pyramid strategy designed to capture every single dollar in the market. At the top, you have the NIO core brand, premium, high-status EVs, which moved over 22,000 units in March alone. Below that is ONVO, their family-focused brand, already contributing nearly 7,000 units a month. And at the base, Firefly, compact, urban-focused, delivering over 6,000 units. By segmenting this way, they aren't just selling a car. They're building a brand for every stage of a consumer's life. Whether you're a single professional in the city or a family of 5, NIO has a door for you to walk through. And here's the question worth asking: what are the chances every major competitor builds an equally seamless three-brand ecosystem before NIO cements its lead, almost zero. And if you think March was a one-time spike, you need to see the catalyst calendar for the rest of April. On April 2nd, they unveiled the 2026 5566 lineup, major facelifts for the ET5, ES6, and EC6, with upgraded assisted driving technology, and here's the kicker, starting price held at zero increase. Then, on April 9th, the tech launch for the all-new ES9 flagship SUV, funded directly by that ES8 success. By month's end, we see the new LiDAR-equipped ONVO L90 and specs for the L85-seater. This is an industrial blitzkrieg. They are refreshing their entire portfolio simultaneously so no competitor can catch their breath. But hardware is only half the battle. The real moat, the thing that makes NIO genuinely difficult to kill, is the infrastructure. While Tesla is focused on superchargers, NIO has been quietly perfecting battery swapping. They just hit 100 million cumulative swaps. Think about the volume of customer loyalty data that represents. And they aren't slowing down. In 2026, they're deploying 1,000 new fifth-generation swap stations. What's revolutionary? This new generation will support the Firefly brand for the very first time, meaning even their entry-level cars will have access to the premium swap-and-go experience. That effectively eliminates the range anxiety argument for the mass market. Can you imagine a competitor building this infrastructure from scratch in the next 3 years? Because I can't. Now this is where the investor-friendly math gets really interesting. NIO has created hardware lock-in. Once you're in the three-brand ecosystem, you need specialized services. Enter Cheche Group, an auto insurance technology platform that integrates directly into the NIO ecosystem. Because of this partnership, Cheche Group reported an adjusted net income of 11.6 million Chinese yuan in 2025. This is the proof of concept for ecosystem profitability. NIO isn't just a car company, they are a platform that other profitable companies pay to plug into. With the home market seemingly secured, the big question becomes, can this model actually travel? NIO just made its move into the Americas. In late March, they opened their first showroom in San Jose, Costa Rica. Now, why Costa Rica? Because it's the perfect testing ground. This is their first overseas location to showcase all three brands, NIO, ONVO, and Firefly, under a single roof. They're testing three-brand integration in a real-world international market before potentially tackling larger Western economies. But it's not all smooth sailing. Their first attempt at Europe was, frankly, bloated, a heavy, centralized management structure that just wasn't efficient. They've now scrapped that and moved to a streamlined, distributor-led model. But here's a crucial warning for anyone reading European registration data. Those numbers are lying to you. Because NIO relies heavily on a subscription model in Europe, a vehicle is only registered once, but that single car may cycle through multiple distinct subscribers over a year. The actual active user base in Europe is likely significantly higher than the official stats suggest. Don't let the registration numbers trick you into thinking they aren't growing there. Now let's look at how NIO stacks up in the arena. Leapmotor is currently leading the New Forces pack with 50,000 deliveries, but growth is stabilizing. Li Auto is at 41,000 units with a modest 12% growth. But look at NIO, 136% growth. Meanwhile, XPeng is in a tailspin, posting a 17.4% year-over-year decline. NIO is effectively cannibalizing the growth of its direct competitors, taking market share from the old New Forces with higher margin vehicles. And while NIO is winning on execution, some Western darlings are facing a brutal reality check. At the 2026 World Car Awards, NIO's Firefly won World Urban Car of the Year. Compare that to Lucid, which won World Luxury Car for the Gravity, but is currently recalling nearly every Gravity SUV produced to date, roughly 5,000 units, due to a critical seatbelt anchor defect. That is the difference between winning awards and winning at manufacturing. NIO has moved past the recall and prototype phase. They are now a production machine. But before you go all in, we have to address two massive elephants in the room. First, potential share dilution. Despite the profitability and record volumes, management recently filed a shelf registration. That means the company could issue more shares and dilute your ownership to raise additional capital. Second, the Chinese EV price war is relentless. NIO is being forced to scale ONVO and Firefly at breakneck speeds just to protect overall volume, while simultaneously trying to protect the ES8's margins. It is a high-stakes balancing act, and one misstep could undo a lot of what they've built. Now let's look at what the charts are saying. NIO has cleared key technical resistance levels, including the 20-day and 200-day moving averages. When the 20-day crosses above the 200-day, it's historically a signal of a major trend reversal. Analyst consensus has shifted to a buy rating, with a fresh wave of upgrades driven specifically by that GAAP profit milestone. The smart money is starting to price in the fact that the bankruptcy risk narrative is effectively dead. So, here's the bottom line. NIO has definitively graduated from high-burn startup status. They have an established asset base of over 100 million battery swaps and advanced in-house silicon that rivals cannot replicate overnight. However, the execution imperative remains high. They must deliver consecutive profitable quarters and successfully navigate the new European distributor strategy to justify a higher valuation. NIO is no longer a bet on whether EVs will happen. It's a bet on whether they can scale the moat they've spent 10 years building. The foundation is there. The walls are built. Now, they just have to defend them. Before I wrap up, please remember that nothing in this video is financial advice. I am not a licensed financial advisor. All content here is for educational and informational purposes only. Always do your own research and consult a qualified professional before making any investment decisions. Past performance is never a guarantee of future results. Now, here's my question for you, and I want to see your answers down in the comments. Do you think NIO can string together 3 consecutive profitable quarters by the end of 2026, or will the price war force them to sacrifice margins to keep volumes growing? Drop your take below. I read every single comment. If you found this breakdown valuable, give it a like. It genuinely helps this channel more than you know. Share it with anyone in your circle who's watching the EV space. And if you haven't subscribed yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss a Smart Stock Sam deep dive. I'll see you in the next one.